to look at this. Now, right here, that's the unemployment statistic that we hear all about all the time. That's 22 million unemployed, right? 69 million kids aren't in the workforce. 90 million can work, but when you ask them, they're not looking. So this is the, when you ask, this is the 15% unemployment number once you add them in. And then 32 million are government jobs. And what this means, or what this is saying, there's this 104 million people in the private labor that are supporting all this non-working and everything else that's out there. You know, paying for all the unemployment benefits that are still being paid out, all the healthcare benefits for people that are retired, all this other stuff up here. And the question is, will that come down if growth continues to decelerate, if earnings aren't really as rosy as they look, or if they're actually decelerating or maybe even declining, again, non-financial companies versus financial companies. Okay. Now we'll look at actual numbers of unemployment. Remember, you hear about this, the participation ratio. You guys heard of this? Participation ratio?
I haven't. Can you explain that?
So there's a number of people not in the labor force, okay, that are no longer participating. They are of working age, they are healthy, they're not working and not looking for a job. Versus, these are people that have left, these are people that are entering. So since 2000, we've had 20 million people leave the labor force versus 5 million that have entered. Now, some of those are retired, some of them have died, some of them have moved to a different country, right? Not 15 million of them, though. So there's a lot of people that have just given up, moved in. I mean, you know these stories, right? I know people that have moved with relatives in another state that have let their house be foreclosed on, and they're not looking for jobs until there's more jobs to be had. So the unemployment statistic looks fantastic. Not really. It looks at 7.5, 7.6%, which is not good, but it's also not even counting a lot of people. Does that make sense? And that's these people. So we talk about 175,000 people entering the labor force, 47,000 people departing the labor force. That's 1 month in a year. Since the stimulus in 2010, so we've had the labor force continue to decline and shrink. These people all, as more jobs are available, will re-enter the labor force and keep the unemployment rate high. The Fed has set a metric. You know, as we get unemployment ticks down, what we're going to do is we're going to reduce QE and we're going to increase low rates. So rates can go up when the unemployment number comes down. But the unemployment number is not going to have a very difficult time coming down because as more jobs come online, more people will re-enter the labor force. To the extent that these are not retirees or people that have passed on or left the country. Recall back in 2007, 2006 maybe, where the value of real estate is skyrocketing. Okay, value of real estate is going up 10, 12, year over year %. And that's not a realistic long-term trend in real estate growth. Is that fair to say? What is the long-term trend in real estate growth? 4, 5% long-term trend. 4% nationally, 5% California. There could be a reset there at some point. And the last print that just happened a couple days ago was 12.2%, 12.3%. So the question is, how much of that is because there's really low inventory? How much of that is because we're just recovering from a dismal problem? Or is the real estate market overheating now? What happens as rates increase? Yes?
Is that percentage yearly?
That's an annual increase, yeah. There's a different statistic that measures month over month. That's way too noisy, yeah. And so here we have Bernanke, mission accomplished, recession is over, right? Okay. So he did this signal, he said this back on, this is the May 9th date. He basically said, mission accomplished, it's over. By September, we are going to taper. What happened May 9th through May 21st? The bond market, which is the safe money, we've talked about this for years and years, didn't hiccup, right? It fell over. And we lost treasuries in May, 10-year treasuries, lost 10% or 4% value in May and again in June. Barclays Ag down 8-9% in 2 months. So we've got to remember, building up to this, we have 5-6 years of people putting all their money in that safe bond market, treasury, can't lose any money here, right?
Could you use the word perceived safe?
Perceived safe, thank you. Yeah, and so this was the May 9th, May 21st, I think marks when we look back 8 years from now, that is the end of the bond bubble. Doesn't mean rates are going to shoot up from here, but rates went from 1.6 to 2.5, and that's what we saw in that first slide with the 4 boxes. You know, the S&P global rates were at 2.6 something at the end of the first 6 months. They were at 1.6, and that increase, because rates went up, any bond portfolio went down in value if it wasn't really ultra short, okay? Ultra short in duration. But, you know, this is the big worry is inflation, inflation, inflation. And we've got 2 different measures of inflation, both of which have been under 2% for a long period of time. How many of you buy that? How many of you believe that inflation, when you go out and buy stuff, is it going up in cost or is it actually staying flat in cost? Food is way up.
Food is way up.
Right? Anything else? Healthcare? Anyone got a decrease in their healthcare bill? Mine's been like 30% increase for the last 3 years. Housing's gone way up. So that's really the key, right? That's one of the keys. So how come, if housing is shooting up in price, how come that's not reflected here? It's because they don't use housing prices. They use owner's equivalent rent. They don't use the price of purchasing a place. They use the price of renting a place. And you can always trade down. Well, this isn't for here, but in just a second. They change the statistics all the time. So GDP, at the end of this month, they're going to change how they measure GDP, and they're going to factor it in historically. So you're going to see the GDP that is below 2 probably jump to 3, and it's going to be very exciting, but nothing will have changed. Because they're going to count something they've never counted before. They're going to start counting R&D as an element of GDP.
R&D is?
Research and development. So they're going to start counting, there's 2 or 3 other things they're going to count. And that the projection, I don't know what it's going to end up being, but the projection is you'll see a doubling of GDP back-tested, right? They're going to increase it and do it historically. So we're going to still have the same curve. But if you don't know that and you just see the new print and suddenly it's 3.5 instead of 1.6, that's going to be very exciting. Interest rates, we just talked about this, ended up 2.6. There's May 9th is the message, May 13th market opens, and that's what rates do between May and the end of June. That's 1.6 to 2.6. That's a huge move in interest rates, very, very quickly. Gold, we talked about that earlier. Silver's down 35, gold's down 28, first half. Okay, this is where we are. Wealth effect. When we look at this number, what is it? Surpassed 70 trillion, up almost 10% from the same time in 2012. That's all the wealth. That's all the stock accounts, it's everything in the country. It's a huge number. And when we measure debt, we have a $16 trillion national debt. Oh my goodness. That's not versus GDP. That's versus assets. Debt versus assets, right? That's your balance sheet. You shouldn't blend your balance sheet in your income statement. They feed each other, but when you do the comparison, the real comparison is versus the asset level. But here's the thing. We're not all welcome in this party, right? Only top 7% have recovered and grown. Everyone else has declined. We have to keep reminding ourselves of this.